Hey, this is Sasha Evdokov, and thanks for joining me here for another episode of Let's Talk Stocks, episode number 84. And in this episode, what I'd like to do is show you how to break apart a chart in detail. Now, before we get into this lesson, I do have a few announcements here. So basically, I'm going to be launching this little book. It's going to be a mini guidebook. It's going to be absolutely free for those of you that are on the newsletter list. You'll be getting that probably within a couple of weeks here. Might be next week, might be the week after that. It's just a small PDF book that I've been working on, and I think it'll just be helpful. It'll be, again, absolutely free, no cost to you, just some knowledge that I think you should read through to make yourself better. And that book is called The 20 Rules for Investing Success. And of course, you can apply these rules for trading as well. If we take a look at the overall market here, this last couple of days have been a little bit more whipsawed action, up and down, and especially today. We're kind of hitting these highs in this range, and we did have a pop on the 10th here on Tuesday, and then a major sell-off on Wednesday, and now again the market tried to pop it, but moving basically sideways today. Tried to drop down, but then they brought it back up. So really, we've kind of been isolating in this little range or region, moving sideways. And if you look at the weekly, you can see we're kind of hitting these higher peaks that we've hit in November, and that's where we're getting into. And your goal is not really to time the market perfectly. Your goal is simply just to find where the money is moving into, the direction that the money is moving toward. Is the risk more so, is it better, more favorable for you to now go to the short side, or is there more room to the upside? So that's what your goal is. And it depends on your time frame or outlook on the stock, the time that you plan to hold it. Now, for me, I typically hold things less than a quarter, so less than a couple of months. And that is simply because of the earnings. And the other accounts that I also trade, I typically will trade ETFs, like the SPX, like right here, SPX, which is the SPY, which is the bigger SPY, or the RUT. And the RUT, you have the IWM, which works with the RUT. So the IWM is the smaller version of the RUT. So the reason I trade these again is because you don't have to worry about earnings. You don't have to worry about fundamental analysis. You simply are trading an ETF. There's no earnings reports. There's no fundamental analysis that you have to do. You just look at the charts. But if you're trading a stock that does have fundamentals, so you need to then evaluate that stock at a deeper level. And by a deeper level, you should also check those fundamentals. Now, typically, stocks with great fundamentals have great charts, and stocks that have great charts have great fundamentals as well. But as you start looking at these charts, you know and understand that typically the technicals, the charts do trump the fundamentals. They are more important when things break down, because as things start breaking down, the fundamentals do not apply. So, for example, when you have this move right here on a retracement basis and then a sell-off, people during this sell-off, this is an ABCD pattern right here, and when people are selling during this C to D leg, they're basically getting out in a panic. And at that point, fundamentals don't apply. They're just trying to get out to save their positions, to save their profits, and so forth. So that's what happens. And that's why typically I always put more emphasis on the charts, because the charts are a little more real time, because the markets will trade irrationally and a little bit crazy when something wild happens. So that's one thing to always keep an eye on when you're trading. So let's take a look at this week's lesson, and let's break apart a chart in detail. And I'll do one that many people are familiar with, so that way you can get an idea of what's going on, what's happening. And I posted this chart on the critical charts as well. So when you first look at a chart, you want to look at the lay of the land. I mean, when you're scanning a stock chart, or when I'm scanning a stock chart, I may scan it on the daily, 2-day, or 3-day. And that is simply the only reason I scan maybe on a 2-day or 3-day is really because I'm able to see more data, more visual data points here. It allows me to go wider on that chart, so it allows me to just see the bigger picture. You can see things from up high. It's kind of like seeing things from outer space. So that's really what I'm trying to do, is I'm trying to see and look at some swing points. I'm trying to find where are my swing points. I'm trying to find what the lay of the land is. I'm trying to get an idea of how that stock's been moving over the course of some time. Now, typically, you really want to go out wide when you're looking at the stock chart. You'll go out to a weekly, you check the monthly, you should be checking the daily. So again, let me re-emphasize that. You need to check the daily, you should check the weekly, and the monthly. Here I'm pushing the number 1 on my keyboard for the daily, the number 5 for the weekly, and the number 9 for the monthly. So you can see here, Apple, we have the monthly right now is up. So this gives me a larger view of the stock. So now I look at this and I wonder, okay, so what is it that I see in the picture? How is the bigger picture in this stock? And when I start looking at this right away, I start seeing some points. So right here in this spot, you see an ABCD pattern that's being created. Okay, and if you don't know what an ABCD pattern is, pick up one of the books that I have, like Start Trading Stocks, or one of the courses, and I'll go over it in detail, like the Stock Trading Foundation course. So here's the A to B, B to C, C to D pattern that was created. And typically these A to B is the same distance that you'll get from A to B as you'll get from C to D. So that's typically the same distance. So if we measure this distance out, this distance right here, if you look at the left side there, the box that pops up, it's right around 89 points. This one right here, when we look at it, we go ahead and we see that this one is right around 80 points. So about 9 points off. I'm not going to hold it against it because we did have a stock split, but about 9 points off. And then we see this retracement coming in. So that's the first thing I noticed. I noticed that the stock is a little overextended. It was overextended at the highs here in 2015. Okay, so that's the first thing I noticed, is because our ABCD pattern was complete. So if you want to break things apart a little bit further, of course you could do Fibonacci sequences and see how those came in, if they are hitting them correctly, so meaning precisely. So you can see here we have a 50% retracement. If I take the lows of 2009 and get them to 2012, you can see that pullback was right around 50%. And what do we know about the pullbacks? Well, a 50% pullback is a healthy retracement and pullback. They can still go down to 61.8 or even back to their original breakout point, and nothing would be wrong with the stock, and then they can bounce off those levels and continue higher. That's just digestion, because stocks don't go straight up. The question comes down to, are you going to be the one that's going to be able to hold it through those pullbacks? So you have to, again, look at your trading time frame. So here, when I look at this one, we've had a 50% pullback, which the pullback was right around that $55 range in Apple. So now again, I can take a Fibonacci sequence from mid-2013 to about that 2015 level and see, this gives me a rough estimate of where that stock can pull back into on a longer term picture. So we could get to the 50%, which we already did, which was actually the highs of 2012. Right there, you could see that line hitting it. So if we look at that line, you can see that line hit it right there, right in the mid of 2012. And we broke that level. You can see we had some support right there, and we broke that level recently. And now we could get back into the 61.8 range, which it would be right around that $90 or so, $88 here, right around that level here where we hit some highs in 2012. So that 61.8% would put us right around there. And we can get there without a problem on this stock. Now, this is a long-term view of the stock. This is a longer term view, and it gives me the bigger picture, and it shows me that this stock can get to, looking at it right here, we got about 85, 86 on the longer time frame view. So now what I do is I look at a little bit of a closer view. So I'll go into a weekly. So I backtrack out of it, and now you can see our ABCD pattern because we're still able to see from 2009 all the way to 2015. There's our ABCD pattern, but it's a little bit less clean. Okay, so now you start taking things in, and right now we know that we're in the upper leg of that C to D. So here's our C to D leg. So you can be a little more precise now if you're trying to do some Fibonacci sequence retracements. You can go ahead and see here as we get into it, where is that 61.8% level. So you can see it's right around that 85.90. If you want to do a precise calculation, there is a precise calculation in the books, in the courses that you can go ahead and take a look at. But for now, for the time's sake, I don't have the time to do that calculation. But basically, you take the lows and the highs, and you take the 61.8% of that, and it brings you down right here to this 85, 86 level. So now you start taking a look at this and you say, okay, so is that stock retracing in a healthy way, or is it retracing in a powerful way to where it could create a more major sell-off? So these are the things you need to look at. So I start looking at the volume. So how is the volume acting? How is the volume acting right now on the weekly? Are we getting buyers or are we getting sellers? And you can see when you look at the current bars, the high bars, you have pickup and selling pressure right here, where it really starts right around the 2015 range, because everything to the left of this, there was more bullish spikes, before 2015. I mean, we did have some pullbacks in 2013, but now everything to the right or forward past 2015, we've had more red spikes or bearish spikes. So that's kind of the concern for me when I start looking at this. And again, you want to check then the monthly. How is the monthly looking? So now, do you see more green spikes or do you see more red spikes? You only see two green spikes within the last, how many months here have we been trading? 10 months. And are we decreasing in volume on these red spikes, or are we increasing? And in fact, you can see as far as the average is concerned, the average of volume, we're actually breaking a couple of those averages. So that means we're starting to pick up and accelerate that selling pressure slowly. So you can see that here on the C to D leg, we were decreasing in volume, which means the stock was running out of steam. People who wanted it got it. Okay, so let me put a little marker here. And if you're listening on a podcast, you might want to watch the video. You can see that it's decreasing right here, and now we're starting to kind of slowly increase as we got into 2015 and 2016. You can see it's slowly changing direction. These are big ships, so the momentum takes time for it to change direction. So it's going to be a slow process here. It may take a little while for that volume to pick up. We'll see. And it may not get that high because you might see buying coming in around this level. We'll see how the next few quarters go. But now you start looking into, as you get into this weekly and you start looking at it, okay, so we have some selling pressure. So now you start looking at, okay, where is, you could be the person that says, let me wait, let me be patient, and I want to buy this as a value play, or I want to short it. So first off, where do you create this position, or what do you do currently? And when would you buy it as a value play? So here's what I would do. When I look at this now we're still on the weekly chart. Okay, I look at the previous swing point highs. So I'm looking here still at the weekly. Even if I'm buying a stock for a day or two, couple days, I'm still going to check the weekly and the monthly. So I'm looking at this swing point here, which is right around the 2012, January, February 2012. The highs of that are right around $93. And then I'll draw that across, and I'll look at the swing points that it's hitting right there. And you can see where it's hitting some of those swing points that are around August 2015, and then you're hitting February of 2016. So here you have some of these highs and lows. So then I take a look at the price. I watch the price. The price is, what is the high price and what did it reject with? Okay, the high price here is 92.03. So call it 92 to make it even. What was the previous week there? The high price, 90.69. So 90. 90 is the price I'm looking at. What about the swing point here on August 28th, 2015? So I look at this and then I evaluate what is the price here on this bar. So on this bar, the low of the price, because this was a bounce, was 92. Exactly 92. Okay, and I evaluate then the next ones as well in February. So in February here we have 92.39. We also have 93.69 and 92.59. So we bounced around that level, and we did it on what volume? So I'm looking at what volume did we bounce at? Okay, what volume was coming in for those weeks? Okay, and for those days. So that's what I want to evaluate next. Okay, so I'm looking at it now on the daily. So I take it out now to the daily, and now I start evaluating this more intermediate term. So if I look at it on the weekly, if I'm looking to short the stock, this is my line in the sand. And I've posted this one in the critical charts a couple weeks ago as well. So this would be my line in the sand. So that is what I'm watching in order to get into that trade. And if I'm looking to go short, I'm waiting for that line to break, and I'm checking the volume of that. So now I look at it on the daily, because now I'm ready to make my decision. So I see if this confirms to what I was reading on the monthly, the weekly, and now the daily. So here, this stock tried to break on 8/24 on Monday, these flash crash lows here with 162.1 million, call it 162 million. It couldn't do it. Not enough time yet. Okay. Then we get back down, and now we bounce with 55 million. Okay. This is on January 28th, 2016. So we bounce on 55 million. Then we try to get there. We bounce on 50 million. We bounce on 40 million. So we try to do a few bounces here on basically 36 and so forth million. After that bounce right here, we get this bounce and we try to climb a little higher because we couldn't break it lower, so they'll take it higher. So what happens to the volume? Well, if you take a look at the volume, you notice that the volume starts to dry up. Notice how this volume creates a drying up action. It decreases. Whereas here, in from about December to February, December 2015 to February 2016, look at the amount of volume that was traded there to the downside. It's picking up speed. It's picking up energy. So now we push it higher on lower volume, and then once we get into that next level where it breaks, it can't hold that support. It takes it out on, look at the volume that it takes it out on, 46.9 million, whereas the previous day you only had 25 million. The day before that you had 33 million, but it took it out right here on basically 46 million and then 60 million. That's your sign. That's your clue. And then you had earnings coming out, took the stock even lower, and now that stock was hanging around right around that 92 level. It was trying to hold that support from before over here at this level of that we tried to do on the flash crash, and the same thing that we tried to do here over in February, and it tried to hold it. Now, think of this like a hammer, keeps hammering on the roof. And the more that it keeps hammering on this roof, the more likely it's going to break that roof. And eventually, it took, let's see here, you have to be a little bit patient. It took 2 weeks, 12 days, 13 days, took about 2 weeks to break it. But today we got that break, and we did it on 76.1 million. So the previous day it was 28 million, then you had 33 million, 32 million. But today we did 76 million, nearly double the average, almost triple what we did the previous day. And now it broke. So this takes that stock to a whole new territory. So now when we break this level, what does this mean? Well, that would be your short entry point. Really, you could have went short even before that, right around this level, but you had earnings right here, so you probably would have gotten out, and then you could have got back in it again, but you'd have to be careful because you could have had a bounce here again, just like we had this bounce that ran that stock up. So your safer position actually was right now, that break. Now, you want to watch tomorrow to see if you get a follow-through day, because if you don't, what can happen is it can retest this level and try to get back up to here. And if it rejects it, that confirms your move. Now, we did have massive volume, so because of that, I'm pretty sure it'll continue moving lower with time, but that doesn't mean you can't come back up to retest this $90, $92 price level, okay? But here we broke on massive volume. So now I look at where do we project this stock to go. If you're short, now you just ride it down and take some profits into strength and continue to peel back your position. Remember, stocks don't go straight down. And remember, it's still Apple. So because it's Apple, there's going to be people that are going to love this stock and try to get it as a value play. So you might not be able to ride this one down to, let's say, the $55 level. But let's see, where can you ride it down to on the short side, and where would it be a good place to buy it as a value play? Because now if you don't trade short, you might be wondering, well, where is it a good favorable price, and where is it that I could step in? Well, I like to use the example similar to what Win did right here. When you see this move, you can see Win has been moving down sideways. And if you look at the pattern, again, the overall weekly, which basically did the same thing that Apple was doing. Here's the A. You have the A to B. Stocks move in the same way. B to C and C to D, okay? And now we're selling off huge, okay? That sell-off lasted in Win from 2014, right around 1.8, almost 2 years. And then we had a sideways consolidation. So what's healthier and better to see in Apple is this sideways move. If you can see this sideways move for about 6 months, 3 months, that's healthier. So here you can see we were moving sideways, then down, sideways, down, and then a larger sideways. You can see how much larger the last sideways move was, because it had to change that boat, turn that boat around, and now it's starting to climb higher. So now you might get a higher prices, retracements, higher prices, retracements. So that's typically how the movements work. So if you apply this to Apple, what's going on here? So, well, now we're doing this pullback motion. So you got here, pullback, retracement, down, retracement, down, retracement, down. So this is the pattern that we're moving in. So again, you can apply the ABCD pattern. So if we take, let's say here our descending trend line, you can see it's making lower highs. Okay, so you can continue doing this and continuing this motion. Okay, so now I do a measurement. Okay, if I do an ABCD pattern, I can see, okay, was this retracement somewhat favorable when we went to the highs here? Here's my daily. Okay, so this is my most recent pattern. So I take the fib sequence from the swing highs to these lows, and look at how this retracement came right in to that 61.8 level right here and rejected those prices right around the 111. It's not going to hit them perfectly, but it rejected them at 111. So this would be my A to B. So here's my A to B on the shorter term, of course, because we're on the daily, C2, and then where is going to be the D? So that's the question mark. So now I'm looking at it and I backtrack a little bit. So I zoom out. This is the weekly. I pressed 5 on the keyboard. So I take this measurement from the highs here to the lows here. We did 31, call it 32 on the downside. Okay, so that's our initial measurement. Then I do the next measurement. I take it 32 points down, which puts me right around the $80 price level. And if you look at it, a fairly interesting place in that stock. Okay, so at this $80 level, notice how we're hitting these highs around the 2014 level, okay, and the lows here of the 2012 level. So we're hitting some predominant levels here at the $80 level. So that would be a nice value play position, and you want to watch how it comes into this, because if it comes into this really slowly, like this, slowly, more than likely it'll bounce off of that level. If, on the other hand, it comes in and it starts coming in fast, more than likely it'll break through that level. And now you got to reevaluate things, and maybe it'll get down to around the $60 level, because then you'll have to reevaluate what's going on and what's happening. But you want to watch. If it's a slow move and it starts to roll a little bit, you might see it bounce, and that could be your value opportunity, is when it starts to come back into this crescent dip shape. Otherwise, if it's going down and then it goes quickly, and it'll break through. So that's some of the things you want to pay attention to when you're looking at a chart. And that's how you really break a chart down, at least in a quick, simple form. More detail than normal, probably, and more detail than what you normally go through. But you want to watch all those things, whether you're day trading, whether you're swing trading. You want to break those things down on the chart and start looking at them in that way. You want to start looking at the charts on that weekly. You want to look at them on the monthly, and then you want to look at them on the daily, and create this story behind the prices, the price movements of these stocks. Because once you do that, you'll be able to really understand what's going on underneath the surface. If you simply just look at the chart and you get confused, then you need to take a step back and reevaluate that chart and reevaluate what's going on underneath that surface. So I hope this was helpful. We broke things down a little bit. In one of my future courses, we'll probably go into breaking things down even more in detail than this. We'll go into some extreme detail and breaking it down, but that, of course, is sometime next year in the future as we wrap up some more training material. So in either case, for now, keep your eyes out and peeled for the 20 Investing Rules book, which should be coming out here in the next couple of weeks, absolutely free. You'll be able to download it. Just make sure that you sign up to the newsletter. Again, it's just one of those things that I think you should go through and apply and use for your investing and trading strategies. And it's just my way to thank you for watching the videos, for being so kind, and for just embracing the material. So thanks again for joining me. I hope you have a great weekend ahead here. We're actually going to be going to Georgia for a wedding, one of my college roommates' wedding, actually. So we'll be down there for the weekend and, just having a good time, probably checking out a few sites over there, some caves and things like that. But in either case, make it a great weekend for yourself. Have a good time. Practice, study, continue to evolve, and get better. In the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.